Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 5th of December 2021, and we're looking at what is likely to happen to the equity market during the course of the next 12 months, and our own assessment on why we believe it's not looking favourable for those invested in equities, and even esoteric areas such as cryptocurrencies. And in case you think you're safe from both, just beware of your pension funds or 401ks, as you may be surprised how much of their performances are determined by strong and progressive equity market growth. So let's take a look. Now, before we look at equity markets, a quick shout out to our gold and silver update, which we published yesterday, and we've placed a link both in the description box below and at the top of the comments section. Now, last week we saw equity markets in the US and across the world spooked by the advent of this new COVID-19 variant called Omicron. Just as the world felt it was coming out of the economic malaise and equity markets were hitting all-time highs, once again a pin has appeared to potentially burst this economic bubble. The Dow Jones over the past month fell by 4.8%, most of which occurring in the past 2 weeks. The S&P 500 has fallen by 3.4% and the Nasdaq by 5.6%. In Europe, the Eurostoxx index has fallen by 6.5%, the FTSE by 2.5%, the DAX by 5.5%, and the CAC 40 by nearly 4%. In Asia, the Nikkei 225 has fallen by 5.4%, the Topix by 4%, and the Hang Seng Index by nearly 4.5%. Omicron or not, we should not be surprised by these falls for a number of reasons. First, let's take price-to-earnings ratios. The Dow Jones Index stands at 21.5, the S&P 500 at 28, and the Nasdaq at almost 35. Now, whilst these are not the highest they've ever been, they are considerably higher than their average, and therefore have to fall back eventually to an average state. Secondly, stimulus is running out and cheap money is about to become more expensive. Yes, indeed, with the Fed beginning its bond buying tapering, and numerous central banks around the world either beginning or threatening interest rate rises, none of this will be good short-term for equity markets. And thirdly, economic performance. Whilst we have seen some recovery in the past year or so, all this may come to an end should further shutdowns occur due to the new COVID-19 variant. This will undoubtedly affect traders' assessments and will, in our view, lead to a significant stock market fall should these lockdowns occur. And in some cases, just the fear of them may be enough to spark that descent. For those thinking they may escape the likes of cryptocurrencies may also be disillusioned, as we've seen the crypto market is highly correlated to the equity market and tends to move in a similar direction. Also, many believe the crypto market is also in a significant bubble at this time. Now, let's be honest, we would all like to think that monies will move into gold and silver, and we believe that to some extent it will. Though, having looked at last week's performance, even during this beginning of a potential equity fall, gold fell $9 and silver fell 58 cents. We must be mindful that any disruption to economic growth will affect silver prices adversely. So any gains it may make on the monetary side could be offset by the lack of industrial demand. Therefore, we suspect that its performance will underplay that of gold's. We should also bear in mind, at least initially, when we had the 2008 economic crash, gold and silver prices also fell, at least early on. Now, will it be different this time? Who knows for certain. But what is interesting is an article we found on Bloomberg today, which to some extent addresses the equity question. Let's take a look. Well, firstly, taking a look at a Bloomberg article this morning concerning equities. Quite an interesting article, actually. 5 words marked 2021 for world stocks and may do again in 2022. It's hard to make predictions, especially about the future, or so the saying goes. That's certainly the case when it comes to stock markets. This time last year, your average strategist may not have seen that the world's best performing index in 2021 would be Mongolia, or that a movie theatre chain would offer about 1,200% returns. And while most analysts had foreseen the rebound following the pandemic-induced slump, few had predicted the sheer ferocity of the rally that pushed European and US stocks to successive records, or the more recent dip after the emergence of the omicron variant of COVID-19. Even fewer had forecast the slump in China, or the liquidity crisis affecting the nation's developers. Much of what's happened in stock markets this year has related to specific conditions. It was the worst of times if you put your dollars into Turkish stocks, with the country's idiosyncratic approach to inflation sending the lira into the abyss. It was the best of times if your love for South Korean television had pushed you to invest in Bucket Studio Go, owner of a stake in an agency that represents Squid Game's lead actor Lee Young-jae. Such special cases notwithstanding, there were broader themes that defined the market this year, and even if predictions can prove horribly wrong, you should probably pay attention to these same topics for 2022. COVID-19. Most strategists expect the virus to become a side note next year as the advent of antiviral pills from Pfizer and Merck & Co. add to humanity's arsenal against the deadly infection. Still, if there's one thing the pandemic has taught us, it's that equity strategy is one thing and epidemiology is another. Inflation. Markets looked through surging prices this year, and for good reason, as soaring corporate earnings prove that companies can pass on higher costs to a consumer that remain willing to spend. If inflationary pressures ease in coming months, don't expect a relief rally, and that's what stocks have priced in. Having had its transitory inflation cake in 2021, the market may not get to eat it again in 2022. Price pressures, inflation expected to peak at the turn of 21-22 before gradually receding. Should price pressures persist or intensify, things could get tricky. Carbonisation. One reason that inflation may stay structurally higher is the transition to climate neutrality, a goal towards which the world's biggest economies, from the US to India, collectively committed this year. Higher carbon prices and environmental taxes increase production costs for industrials. The metaverse. Facebook's rebranding drew attention to a growing space of economic activity outside the physical world, from social media to gaming platforms. China. Beijing rolled out swinging measures to curb the profits of technology giants and tutoring firms this year, and imposed restrictions on lending to real estate developers to cut its independence on the sector. More. Staying on top of these themes won't necessarily guarantee meaningful returns for investors. Potential black or white swan events are lurking everywhere, from the US midterm elections to the French presidential vote, and from tensions in Taiwan to a full-blown crisis in Turkey's economy following the plunge of the lira. Supply chain bottlenecks will continue to be closely watched, while global warming is another wild card that traders may need to consider. While Goldman Sachs sees markets grinding higher next year, Bank of America Corp takes a rather apocalyptic view, predicting low or negative, and in any case volatile returns in 2022. If we've learned anything from 2021, it is that focusing on the fundamentals of companies you invest in isn't always the most rewarding strategy. Going forward, Goldman Sachs advises investors be selective, avoiding firms with high labour costs and stocks valued entirely on long-term growth expectations. But then again, that's what strategists advised last year. Well, what does this mean moving forward? As we quoted in our weekend update, there are a number of issues to be wary of. Russia and Ukraine, China and Taiwan, climate change taxes which will inevitably increase, and shorter term, the Omicron variant, and the potential for more shutdowns. All of this negativity should be truly positive for gold prices, but again, the prospect of increasing rates, real or illusionary, and the ever-increasing strength of the US dollar due to perhaps worse economic problems in other countries may temper gold's price rise for a while. Inevitably, we believe it will resurrect, but there may be more pain before we see a greater gain. What do you think? Do share your thoughts. Thank you so much for listening. If you haven't done so, please subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they're published. And finally, a reminder, if you haven't listened to our weekly update, we've placed links below. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.